This video provides an overview of the major concepts covered in Chapter 15, Swap Markets. Many firms have inflow and outflow payments that are not equally sensitive to interest rate patterns, thereby exposing them to interest rate risk. Interest rate swap contracts have been established to reduce these risks, while credit default swap contracts have been established to reduce credit risk. Chapter 15 includes 8 learning objectives. First, to provide background information on swaps. Second, to describe the types of swaps that are available. Third, to explain the risks of interest rate swaps. Fourth, to explain how interest rate swaps are priced. Fifth, to identify factors influencing interest rate swap performance. Sixth, to identify other interest rate derivative instruments that are commonly used. Seventh, to explain how credit default swaps are used to reduce credit risk. And the last learning objective is to describe how the swap markets have become globalized. Let's begin with some background information on swaps. An interest rate swap is an arrangement whereby one party exchanges one set of interest payments for another. In the most common arrangement, fixed rate interest payments are exchanged for floating rate interest payments over time. Financial institutions in the U.S., such as savings institutions and commercial banks, traditionally had more interest rate sensitive liabilities than assets and therefore were adversely affected by increasing interest rates. Conversely, some financial institutions in other countries, such as commercial banks in Europe, had access to long-term fixed-rate funding but used these funds primarily for making floating-rate loans. These institutions were adversely affected by declining interest rates. This exhibit illustrates how the U.S. and European financial institutions can engage in an interest rate swap. In the event of rising interest rates, the U.S. financial institution receives higher interest payments from the floating rate portion of the swap agreement, which helps offset the rising cost of obtaining deposits. In the event of declining interest rates, the European financial institution provides lower interest rate payments in the swap arrangement and receives fixed rate payments, which helps offset the lower interest rate payments received on its floating rate loans. Some interest rate swaps are combined with other financial transactions, such as the issuance of bonds. Corporate borrowers may be able to borrow at a more attractive interest rate when using floating rate debt rather than using fixed rate debt. Even so, if they want to make fixed payments on their debt, they can swap fixed rate payments for floating rate payments and use the floating rate payments received to cover their coupon payments. Alternatively, some corporations may prefer to borrow at a floating rate but find it advantageous to borrow at a fixed rate. These corporations can issue fixed rate bonds and then swap floating rate payments in exchange for fixed rate payments. Let's look at an example. Assume the quality company negotiated with risky company to provide variable rate payments at SOFR, or the secured overnight financial rate, plus 0.5% in exchange for fixed rate payments of 5.5%. Quality company benefits because its fixed rate payments received on the swap exceed the payments owed to its bondholders by 0.5%. Its variable rate payments to risky company are the same as what it would have paid if it had issued variable rate bonds. Risky is receiving SOFR plus 0.5% on the swap, which is 0.5% less than what it must pay on its variable rate bonds. However, it's making fixed rate payments of 5.5%, which is 1% less than it would have paid if it had issued fixed rate bonds. Overall, it saves 0.5% per year on financing costs. Interest rate swaps are sometimes used by financial institutions and other firms for speculative purposes. For example, a firm may engage in a swap to benefit from its expectations that interest rates will rise, even if not all of its operations are exposed to interest rate movements. Financial institutions participate in the swap markets in various ways, as summarized in this exhibit. Financial institutions, such as commercial banks, savings institutions, insurance companies, and pension funds that are exposed to interest rate movements commonly engage in swaps to reduce interest rate risk. Now let's discuss the different types of swaps. In response to firms' diverse needs, a variety of swaps have been created. In a plain vanilla swap, sometimes referred to as a fixed for floating swap, fixed rate payments are periodically exchanged for floating rate payments. A forward swap involves an exchange of interest rate payments that does not begin until a specified future time. These are useful for financial institutions or other firms that expect to be exposed to interest rate risk at some time in the future. Another form of interest rate swap is swap options or swaptions. A callable swap gives the party making the fixed payments the right to terminate the swap prior to its maturity. It allows the fixed rate payer to avoid exchanging future interest rate payments if it desires. A puttable swap gives the party making the floating rate payments the right to terminate the swap. An extendable swap contains a feature that allows the fixed for floating rate party to extend the swap period. Another special type of interest rate swap is the zero coupon for floating swap. The fixed rate payer makes a single payment at the maturity date of the swap agreement, and the floating rate payer makes periodic payments throughout the swap period. A rate cap swap involves the exchange of fixed rate payments for floating rate payments that are capped. An equity swap involves the exchange of interest payments for payments that are linked to the degree of change in the stock market. Some types of swaps involve payments that are not dependent on interest rates. One example is a tax advantage swap, which firms implement for tax purposes. Next, let's discuss the risks of interest rate swaps. The interest rate of the index used for an interest rate swap will not necessarily move perfectly in tandem with the floating rate instruments of the parties involved in the swap. This basis risk prevents the interest rate swap from completely eliminating the financial institution's exposure to interest rate risk. One risk when engaging in interest rate swaps is that a firm involved in the swap will not meet its payment obligations. This is known as credit risk. The willingness of large banks and securities firms to provide guarantees has increased the popularity of interest rate swaps, but has also raised concerns that widespread adverse effects might occur if these intermediaries cannot meet their obligations. Sovereign risk reflects the potential adverse effects resulting from a country's political conditions that could prevent the counterparty from meeting its obligation in the swap agreement. Sovereign risk differs from credit risk because it depends on the financial status of the government rather than on the counterparty itself. The next key concept in the chapter relates to the pricing of interest rate swaps. The setting of specific interest rates for an interest rate swap is referred to as pricing the swap. This pricing is influenced by several factors, including prevailing market interest rates, availability of counterparties, and credit and sovereign risk. The fixed interest rate specified in a swap is influenced by supply and demand conditions for funds having the appropriate maturity. Swap pricing is also determined by the availability of counterparties. When numerous counterparties are available for a particular desired swap, a party may be able to negotiate a more attractive deal. A party involved in an interest rate swap must assess the probability of default by the counterparty. Now let's move on to the performance of interest rate swaps. This exhibit shows how the performance of an interest rate swap is influenced by several underlying forces that affect interest rate movements. The impact of the underlying swap on the performance of an interest rate swap depends on the party's swap position. For example, to the extent that strong economic growth can increase interest rates, that growth will be beneficial for a party that is swapping fixed rate payments for floating rate payments, but is detrimental to a party that's swapping floating rate payments for fixed rate payments. The next learning objective pertains to interest rate caps, floors, and collars. An interest rate cap offers payments in periods when a specified interest rate index exceeds a specified ceiling or cap interest rate. A typical purchaser of an interest rate cap is a financial institution that's adversely affected by rising interest rates, whereas the typical seller of an interest rate cap is a financial institution that expects interest rates to remain stable or decline. An interest rate floor offers payments in periods when a specified interest rate index falls below a specified floor rate. The interest rate floor can be used to hedge against lower rates in the same manner that the interest rate cap hedges against higher interest rates. An interest rate collar involves the purchase of an interest rate cap and the simultaneous sale of an interest rate floor. Any financial institution that desires to hedge against the possibility of rising interest rates can purchase an interest rate collar. Now let's look at credit default swaps. A credit default swap, or CDS, is a privately negotiated contract that protects investors against the risk of default on particular debt securities. The main participants in the CDS market are commercial banks, insurance companies, hedge funds, and securities firms. The swap involves two parties that have different needs or expectations about the future performance of particular debt securities. The buyer is willing to provide periodic payments to the other party, the seller. Thus, the seller receives the payments from the buyer, but is obligated to reimburse the buyer if the securities specified in the swap agreement default. In this case, the seller pays the par value of the securities in exchange for the securities. Alternatively, the securities may be auctioned off by the buyer, in which case the seller must pay the buyer of the CDS the difference between the par value of the securities and the price at which those securities were sold. A secondary market for CDS contracts exists in which CDS dealers serve as intermediaries. The secondary market allows financial institutions participating in a CDS contract to pass on their obligations to other willing parties. When the securities protected by a CDS contract decline in price because of the conditions that increase the likelihood of their default, the seller of the CDS must post a higher level of collateral to back its position. Holding maturity and notional value constant, the payments required on a new CDS are positively related to the default risk. In periods when economic growth is strong, the payments required on a CDS contract on most securities should be relatively low because the default risk is usually low under those conditions. In contrast, when economic conditions are weak, the payments required on a CDS contract on most securities should be relatively high because the default risk is high. When a firm encounters financial problems, its creditors attempt to work with the firm to prevent it from going bankrupt. They may be willing to help the debtor firm avoid bankruptcy by accepting a fraction of what they are owed, as they may receive even less if the firm files for bankruptcy. However, if creditors have purchased a CDS contract, they may benefit more if the firm goes bankrupt because then they'll receive payment from the seller of the CDS. Thus, creditors who hold CDS contracts may have less incentive to help a debtor firm avoid bankruptcy. During the housing boom in the 2003 to 2006 period, many financial institutions accumulated large holdings of mortgage-backed securities. Some financial institutions used credit default swaps to take speculative positions on their expectations that many mortgages would default. During the credit crisis, the sellers of many credit default swaps didn't establish a sufficient margin backing the agreement. Lehman Brothers was a major participant in the CDS market. When it went bankrupt in September 2008, it didn't cover all of its CDS obligations. American International Group, AIG, frequently sold CDS contracts as a means of generating periodic revenue. By 2008, many of its CDS contracts obligated AIG to cover risky mortgage-backed securities that represented subprime mortgages. As housing conditions weakened further, rumors circulated that AIG might not be able to cover all of its future claims on its CDS contracts due to defaults. By early 2009, AIG had received $150 billion in government funds. Even after the credit crisis ended, their positions in CDS contracts resulted in substantial losses for some financial institutions. In the aftermath of the credit crisis, the Financial Reform Act of 2010 mandated substantial reforms of CDS contracts and the swap markets in general. Both the Commodity Futures Trading Commission and Securities Exchange Commission issued new rules and regulations aimed at increasing the transparency of the swap markets, improving market efficiency, and reducing the systemic risk caused by derivative securities. The last concept in the chapter is the globalization of swap markets. Interest rate swaps are executed in various countries and are denominated in many different currencies. Financial institutions from numerous countries also participate in the credit default swap market. A currency swap is an arrangement whereby currencies are exchanged at specific exchange rates and at specified intervals. It's essentially a combination of currency futures contracts, although most futures contracts are not available for periods in the distant future. Currency swaps are commonly used by firms to hedge their exposure to exchange rate fluctuations. Although currency swaps are commonly used to hedge payments on international trade, they may also be used in conjunction with bond issues to hedge foreign cash flows. This exhibit illustrates a currency swap whereby Philly Company, a U.S. firm, wants to issue a bond denominated in euros because it could make payments with euro inflows to be generated from ongoing operations. Philly, however, is not well known to investors that would consider purchasing euro-denominated bonds. Another firm, Windy Company, wants to issue dollar-denominated bonds because its inflow payments are mostly in dollars, but Windy is not well known to the investors who would purchase these bonds. If Philly is known in the dollar-denominated market and Windy is known in the euro-denominated market, Philly could issue dollar-denominated bonds, while Windy issues euro-denominated bonds. Philly can exchange euros for dollars to make its bond payments, and Windy will receive euros in exchange for dollars to make its bond payments. The same type of risks that apply to interest rate swaps may also apply to currency swaps. Those include basis risk, credit risk, and sovereign risk.